If you have a qualified retirement fund, such as a 401k, TSP, 503b, or IRA, your money is at risk of being lost to the vagaries of the stock market. Not even real estate or hard assets are immune from market risks. That should not be news to you. If you are in your 20s or 30s, that risk may not be as scary to you as it should be to those in their 40s and 50s. And here's why. Statistics show that if a retirement fund gets hit with losses, it can grow back to where it was before the loss in about 10 years. It will never recover the losses, as so many financial planners like to tell their clients, but it can grow back to the level it was at before the loss. But if you're closer to retirement, a big hit on your retirement account can seriously hurt your retirement income because your account may or may not grow back to where it was before the loss. And even if it does, you will have lost that 10 years of gain that it took just to grow back to where it was before the loss. In today's erratic economic environment, especially, many smart people are looking for something that will provide safe, guaranteed growth for their retirement accounts and save their money from the loss risk inherent in the market. Maybe you're one of them, and you've heard of the wonders of infinite banking, and you're investigating this strategy to see what it can do for you. Kudos to you if you are. Aloha, I'm Stan Cox, principal broker and strategist with SC Finance Strategies and Insurance Consultants. I'm also the author of the books on the tax-free cash growth warehouse strategy, and I'm the managing director of the Hawaii Financial Free Thinkers Academy, a nonprofit financial literacy education organization. For the past several years, I have focused on and specialized in the infinite banking concept and developing the tax-free cash growth warehouse finance strategy. If you find this to be helpful, please like this video and subscribe to this channel and share it with your family and friends. Also, please post your questions and comments here. Now, let me ask you a question. Does putting your money in an account that is guaranteed to grow with high compounding tax-free interest, completely free from the risk of loss, does that sound good to you? Would it be helpful to you if you could leverage that money to finance things that you buy now or to help in an emergency without slowing the growth of your account? Yeah. And how would it feel knowing that your account will actually pay a guaranteed tax-free benefit several times the amount that you pay into it to your loved ones in the case of your death? Well, I'm sure that you answered yes, yes, and sounds great. Am I right? And those are just some of the reasons a properly designed participating whole life insurance policy is the most desirable rescue solution for your at-risk retirement accounts. But you might say, I've heard that the IRS limits the amount that you can load into a life insurance policy. What about that? Because I have a bunch of money saved in my retirement accounts, and I want to rescue it from the market so that I know that it'll be there and more when I retire. Well, now that would be what is called a MEC limit. And it's not that you can't exceed that limit, but if you do, you lose the tax-free growth part and the tax-free leveraging part. So yeah, we want to avoid the MEC limit. And now I'm going to lay out the solution for all of that. I started using this strategy several years ago when a client had $3,000 or $4,000 in their 401k and wanted to load it into an infinite banking account. And now I have helped many more clients with this same strategy. Typically, we want to get all that money into the tax-free cash growth warehouse account as quickly as possible. And we want to avoid paying tax and penalties as much as possible in the process. Of course, you probably know that the IRS is actually in control of all those qualified accounts, and they will slap you with a 10% penalty when you take any money out of your qualified account before you're 59 and a half years of age. That's on top of the income tax on that money. So here's the solution. First, we'll open a special type of qualified annuity called a single premium immediate annuity, or SPIA, S-P-I-A. That means you only pay into it once, and the annuity pays a guaranteed interest rate that is locked in at the start of the annuity, and you can begin taking payments from the annuity as soon as 1 month from the start date of the annuity. Because it's also a qualified account, your at-risk retirement account can be rolled over into the annuity with no tax or penalty. And it will grow with that guaranteed interest rate, tax deferred. We set up this annuity to provide immediate income and design it to pay out an annual amount that will cover the premium for the special infinite banking life policy, including the maximum amount of cash load per year that will not trigger the MEC. Now, typically, we'll design the infinite banking life policy as a 10-pay policy. And that simply means that the premiums are designed to be paid for only 10 years. And by then, the policy is fully paid up. And with the annuity designed to pay out fully over 10 years, all the money in your retirement account will be transferred into your new tax-free cash growth warehouse account over that same 10 years. Now, to answer your question, and I know that this question was popping up in your head, what about the payments from the annuity? Because they were in the qualified annuity and then paid out annually. Don't I have to pay tax on those payments? The answer is yes, you do. And the 10% penalty if you're not 59 and a half yet. But we set up the annuity so that it does not withhold the tax and penalty, if there is a penalty. So the full annual distribution is paid to you. That way, the payment of the tax is your responsibility. The same as all the rest of your income tax. But here's the trick, and maybe one of the best uses for infinite banking. When you get the money from the annuity each year, you put it into your policy as the premium and just let it accumulate the compounding interest. Then, when tax time comes around the following year, you leverage your cash value with a policy loan to pay the tax. Policy loans are not treated as income and therefore not taxed. So you pay your tax with the policy loan, and all your money remains in the cash value of your tax-free cash growth warehouse account and earning that high compounding interest. Yeah. The small amount of simple interest charged to the policy or for the policy loan is less than what you're being paid in the compounding interest. So you're still coming out ahead. And you don't lose the money you pay in tax because it's still in your account earning that compounding interest. This is the only way you get to actually keep the money that you pay to the IRS and earn interest on it. You may even be able to deduct the small amount of interest that you pay on the policy loans. Now, this is the strategy for rescuing your retirement savings and getting it into the high compounding interest, tax-free cash growth warehouse account that powers the infinite banking strategies, which is the most powerful finance strategy in history. Again, if you found this to be helpful, please like this video and subscribe to this channel and share it with your family and friends. You have questions, we have answers. For a more complete explanation of the tax-free cash growth warehouse strategy, you can watch our free 60-minute webinar. The link is in the description box below here. The link to buy my books on Amazon.com is also below. And if you'd like to book a free phone consultation with me, the link to my Calendly page is also below. If you'd like to apply to become a client of ours, we would encourage you to do so. The link is in the application below. We're here to help, and we look forward to helping you. Aloha and mahalo for watching.